Imagine walking into a bank when you are 17 years old. You have no credit history, no collateral, and no income. You ask the loan officer for $100,000 to buy an asset that you cannot sell, cannot return, and cannot insure. In any rational economic system, you would be laughed out of the building. But in the American education system, they hand you a pen. We treat college degrees like golden tickets, assuming that the piece of paper automatically justifies the cost. But I've been running the numbers on the current landscape of tuition inflation versus wage stagnation, and the math has shifted. We are looking at a market where some degrees are essentially subprime mortgages on your future, while others are the only arbitrage opportunity left for the middle class. Today, I am not talking about following your passion. I am talking about the degree ROI Index. We are going to calculate exactly which majors build wealth, and which ones are just expensive hobbies. Before we start picking winners and losers, we have to agree on how we keep score. Most people calculate the value of a degree by looking at the average starting salary. That is a mistake. That is like buying a house based solely on the paint colour while ignoring the foundation. To get the true return on investment, or ROI, we have to factor in the opportunity cost. This is the money you did not make because you were sitting in a lecture hall for 4 years instead of working. We also have to look at the debt service ratio, which is how much of your future monthly income is eaten up by student loans before you even buy groceries. When you view a degree through this lens, the hierarchy of good majors looks very different than what your high school guidance counselor told you. I treat this analysis the same way I treat a stock portfolio. We are looking for yield, risk, and time horizon. If you appreciate an approach to life that prioritizes hard data over warm, fuzzy feelings, you are in the right place. The best return on investment you can get right now costs $0 and takes 1 second. Hitting that subscribe button helps me keep the lights on so I can keep digging through these financial reports for you. Now, let's look at the first category. These are the degrees that parents love to brag about, the safe bets. I am talking about law and medicine. The common belief is that these are the golden paths to the upper class. But when you strip away the prestige and look at the ledger, the reality is much messier. Let's start with the classic path to riches, becoming a lawyer or a doctor. The cultural narrative here is strong. We grow up seeing lawyers on TV in bespoke suits closing million-dollar deals, or surgeons driving Porsches. The assumption is that while the schooling is hard, the payout is guaranteed. It is viewed as the ultimate safe harbor. You trade your 20s for a library card, and in exchange, you get a lifetime of financial immunity. Parents push these paths because they seem recession-proof. After all, people always need legal defense and heart surgery, right? This perception creates a massive demand for law schools and med schools, allowing them to hike prices with impunity. They know you will pay whatever they ask because you believe the salary at the end of the rainbow is infinite. But the market has become saturated with people who bought into this exact same story. Here is the cold math. To become a lawyer, you are looking at 7 years of schooling. To become a doctor, it is closer to 11 or 12 before you see a real paycheck. Let's look at the law degree first. The average law school debt sits around $160,000. That sounds manageable until you realize the interest rates on Graduate Plus loans are often north of 7 or 8%. But here is the kicker. The salary distribution for lawyers is bimodal. That means there are 2 peaks. A small group makes $190,000 to start at big firms, but the vast majority make somewhere between $50,000 and $70,000. If you have $200,000 in debt and you are making $60,000 a year, you are technically insolvent. You are not rich, you are a broke person with a fancy title. The math for doctors is even more aggressive, often involving $500,000 in lost wages during residency. Now here is the twist that catches almost everyone off guard. It is the concept of lifestyle creep combined with golden handcuffs. Because society expects a doctor or a lawyer to look successful, these graduates often lease the luxury car and buy the big house immediately upon graduation, leveraging themselves even further. But the real hidden cost is the stress to earnings ratio. High-paying law and medical jobs have some of the highest burnout rates in the economy. I have seen the data on career satisfaction, and it is grim. You might be making $200,000, but if you're working 80 hours a week, your hourly wage is actually comparable to a shift manager at a warehouse. You are essentially selling your life force for a tax bracket. If you quit, the debt remains, but the income vanishes. That is the trap. You literally cannot afford to stop working a job you might hate. So, what is the protocol if you are dead set on this path? You have to be elitist about it. For law, the ROI only makes sense if you get into a top 14 school, or if you get a full ride scholarship to a lower tier one. If you are paying full price for a mid-tier law degree, you are buying a liability. For medicine, the strategy is specialization. General practice barely covers the debt service in high cost of living areas. You need to target specialties with high barriers to entry. But honestly, for most people, the risk-adjusted return here is lower than you think. But maybe you are thinking, Tom, I don't want to be a doctor, I want to be an engineer. Everyone says STEM is the only way to go. Well, I have some bad news about that guaranteed job in tech. For the last 15 years, the loudest advice in the room has been learn to code. Computer science and engineering degrees were sold as the modern-day factory job, a ticket to the middle class that was available to anyone smart enough to learn Python. The myth is that if you have a STEM degree, you will walk out of college and straight into a six-figure job with free lunch, beanbag chairs, and stock options. We view these degrees as purely functional tools. You input tuition, you output a high salary. It is seen as the pragmatic choice, devoid of the risk associated with the arts. The narrative is that the world is becoming digital, so the demand for people who build the digital world can only go up. It feels like betting on the house. But let's look at the supply and demand curve. The number of computer science graduates has exploded, more than doubling in a decade. On top of that, we have boot camps churning out developers in 3 months. The supply of entry-level coders is at an all-time high, but the demand for junior developers is actually softening. I ran the numbers on entry-level tech salaries relative to inflation, and they are stagnating. Sure, the senior engineers at Netflix make $500,000, but the junior dev at a regional insurance company is making $65,000 in a city where rent is $3,000. When you factor in the rigorous coursework, which often leads to taking 5 years to graduate instead of 4, the opportunity cost jumps significantly. That 5th year of tuition plus the lost year of income can swing the ROI calculation by over $100,000. The twist here isn't just about competition. It is about obsolescence. This is the only field where your degree loses value every single year after you graduate. In law, knowing a case from 1850 is useful. In tech, knowing a framework from 2015 is worthless. You are on a treadmill. And now, we have to talk about the elephant in the server room: artificial intelligence. We are seeing AI write basic code faster and cheaper than a fresh graduate. The safe technical skills are becoming commodities. If your value proposition is just, I can write syntax, you are in trouble. The ROI of a pure coding degree is becoming volatile because the barrier to entry for producing code is dropping to 0. The premium is shifting away from building the thing to knowing what to build. The protocol for STEM majors today is to pivot from being a builder to being a solver. Do not just study computer science. Study computer science and finance, or engineering and supply chain management. The highest ROI comes from the intersection of a hard skill and a domain expertise. You want to be the person who understands the code and the business problem the code is solving. Also, consider the unsexy engineering fields. Civil, electrical, and chemical engineering have lower ceilings than big tech, but the floors are much higher and far more stable. We will always need water treatment plants. We might not always need another dating app. But what if you are terrible at math? What if you are drawn to the liberal arts? Is that financial suicide? Before you click away, assuming I am going to bash English majors, listen to this. The common wisdom says that a liberal arts degree is a fast track to being a barista. We joke about philosophy majors asking, "Do you want fries with that?" The perception is that these degrees offer zero hard skills and therefore zero value in a capitalist economy. Parents are terrified when their kids say they want to major in history or psychology. They see it as a waste of tuition, a 4-year book club that costs as much as a Ferrari. But when you dig into the long-term data, specifically looking at career trajectories over 20 years, the graph does something very strange that contradicts the barista narrative entirely. The math on liberal arts is a game of the tortoise and the hare. It is true that starting salaries are low. An English major might start at 45,000, while the engineer starts at 75. However, the data shows that liberal arts majors often see faster salary growth in their 30s and 40s. Why? Because they tend to move into management, sales, and leadership roles, positions that require communication, empathy, and critical thinking. I looked at the stats for mid-career earnings, and the gap narrows significantly. In fact, top performers in the humanities often out-earn technical workers who hit a ceiling because they lack soft skills. The ROI isn't negative, it is just delayed. If you can survive the first 5 lean years without drowning in debt, the curve bends upward. Here is the psychological twist. In an AI world, the soft skills are becoming the hard currency. An algorithm can analyze a spreadsheet faster than an accountant, but it currently struggles to navigate complex office politics, negotiate a delicate contract, or manage a team of humans with different neuroses. The specific knowledge of a history degree might be useless, but the meta skill of synthesizing vast amounts of information and forming a persuasive argument is incredibly valuable. The danger isn't the degree, it is the lack of a plan. The twist is that a liberal arts degree is actually a high-risk, high-reward entrepreneurship training ground, provided you realize that the degree itself is not the job application. You are the product, the degree is just the packaging. The protocol for the liberal arts major is the double threat strategy. Never take a humanities degree in isolation. Pair it with a minor or a certification in a hard skill. A psychology major who knows data analytics is dangerous. An English major who understands digital marketing is unstoppable. You need to bridge the gap between your critical thinking and the market's need for tangible output. Also, you must aggressively network. Since there is no direct pipeline from philosophy class to philosophy factory, your network is your only safety net. If you are not willing to hustle, then yes, this degree is a trap. But there is one category of education we haven't touched yet, and it might just have the highest ROI of them all. This is where we flip the script. Society has spent 40 years telling us that trade schools are for the kids who couldn't cut it in academia. We view plumbing, electrical work, and welding as lower class options. The myth is that these jobs are dead ends, physically brutal, and financially limited. We assume that the white-collar office worker always beats the blue-collar labourer in the game of wealth. This classist bias causes us to overlook a massive inefficiency in the market. While everyone is fighting for the same email-sending jobs in air-conditioned offices, the infrastructure of our country is crumbling, and the people who know how to fix it are retiring. We have a massive supply shortage of skilled tradespeople. And if you know anything about economics, You know what happens to the price of a service when supply drops and demand stays constant. Let's run the numbers on the trade arbitrage. An electrician apprentice starts getting paid at age 18. They have zero debt. By age 22, when the college grad is just leaving campus with a negative net worth of $40,000, the tradesperson has 4 years of income, 4 years of savings compounding in the market, and a skill set that commands $80 an hour on the side. I modelled this out. Assuming the college grad makes slightly more per year, it often takes them until age 32 or 33 to catch up to the net worth of the tradesperson who started at 18. That is a 15-year head start on wealth compounding. If the tradesperson invests that early income difference into the S&P 500, the college grad essentially never catches up. The ROI here is infinite because the investment cost is effectively negative. You get paid to learn. But I have to be honest about the body tax. This is the twist that proponents of the trades often ignore. You are trading physical health for financial health. Knees give out, backs break, and working in crawl spaces gets a lot harder at age 50. The depreciation of your body is a real cost that needs to be factored into the ROI. If you are still turning a wrench at 60, you might be rich, but you might be too broken to enjoy it. Furthermore, there is a social ceiling. It is harder to pivot from plumbing to corporate strategy if you want to change lanes later in life. The liquidity of the skill set is high, but the transferability to other industries is low. The protocol for the trades is to view the tool belt phase as temporary. You are not training to be a worker, you are training to be an owner. The goal is to spend 5 to 7 years mastering the craft and then transition into running a contracting business where other people swing the hammers. The ROI explodes when you scale from a sole proprietor to a business owner. You use that early cash flow to buy assets, not trucks. If you stay a labourer forever, the math eventually turns against you physically. But if you use the trade as a launchpad for entrepreneurship, it is arguably the single best path to wealth in America right now. Now, let's bring this all together and look at the absolute worst ROI degrees, the ones you need to avoid, like radioactive waste. We have to talk about the degrees that are functionally luxury goods. I am talking about specific majors in private arts colleges, things like theatre, fine arts, or niche cultural studies, priced at $60,000 a year. The myth here is the most dangerous one of all. Do what you love and the money will follow. This is a lie sold by institutions that need your tuition dollars to build new student centres. They sell you the dream of the outlier, the one actor who made it big, while ignoring the thousands waiting tables. They conflate a hobby with a career. I am all for being well-rounded, but paying $250,000 to study something you could learn at the public library is financial malpractice. The math is brutal. The average starting salary for some of these majors is barely above minimum wage. If you borrow $100,000 to get a degree that pays $35,000 a year, you are mathematically doomed. The interest alone will likely exceed your disposable income. You will be in a negative amortization scenario where your loan balance grows every month, even while you make payments. I looked at the debt-to-income ratios for these majors, and they are consistently the highest in the country. You are starting your adult life with a mortgage, but no house. It is an anchor that will drag on your ability to buy a home, start a family, or retire until you are well into your 40s. The twist is that these degrees often destroy the very passion they were meant to cultivate. When your survival depends on monetizing your art, the art suffers. You end up resenting the thing you loved because it is the reason you are broke. Furthermore, the credential actually hurts you in some job markets. Employers in unrelated fields sometimes view these degrees as a signal of poor decision-making or a lack of seriousness. It sounds harsh, but I have seen hiring managers toss resumes simply because the major signaled, high maintenance, low skill. The hidden cost is the branding damage to your professional profile in the corporate world. The protocol is simple. Keep it a hobby. If you love painting, paint. If you love acting, join a community theatre. But do not finance it with non-dischargeable federal debt. If you must study it, do it at a community college or use free online resources. We live in the golden age of information. You do not need a syllabus to learn. If you are already in one of these majors, stop the bleeding. Transfer, double major, or drop out and start working. The sunk cost fallacy, the idea that you have to finish because you started, is what keeps people trapped in this cycle. Cut your losses. Your future self will thank you. So, what is the verdict of the degree ROI Index? It turns out that college is neither a scam nor a golden ticket. It is a leveraged investment vehicle with varying risk profiles. The safe bets, like law and med, are high-risk, high-reward, leveraged buyouts of your own time. STEM is a growth stock that requires constant maintenance to avoid crashing. Liberal arts is a value play that requires a long time horizon. The trades are a dividend stock with high yield, but limited capital appreciation unless managed actively. And the passion degrees are penny stocks, fun to talk about, but likely to go to zero. The variable that matters most is not the university brand, but your strategy for utilizing the asset. You need to run your own numbers. Take the total cost of attendance, add 4 years of lost potential wages, and divide that by the difference between your expected degree salary and a non-degree salary. That is your break-even point in years. If the number is greater than 10, walk away. I want to know what you think. Are you using your degree? Did you beat the ROI Index? Or are you still paying for a piece of paper you don't use? Drop your major and your honest review in the comments below. It helps the community see the real data, not the brochure data. Thanks for watching, and I'll see you in the next one.